So good afternoon, everyone. Thanks for coming. Very briefly, my name is Gonçalo Moreira. I'm a content advisor at FX Street. Many of you have been probably attending webinars with me periodically. Today we'll be talking about Dow Theory. This approach will be twofold. We'll be approaching this original theory from an educational point of view, but we will also try to look at the market averages in real time as to gather some analysis of the current situation. We will not look into currency charts, nor will we look into very short term currency charts, or eventually we'll see some of the averages on a shorter time frame. But this may be of interest to you if you want to relate this to other markets. Okay, the Dow theory is a useful place to start learning technical analysis, given its long and rich history, and at the same time it's a good place to refresh some of the principles of technical analysis, such as a trend is a directional movement of prices that remains in effect long enough to be identified and still playable, or the prevailing trend is assumed to be enforced until the weight of the evidence proves otherwise, or prices discount everything, and so on. These arguments that we hear so often nowadays are in fact basic tenets of the origins of technical analysis as they have been established in those theory. In today's session, like I said, we will not only approach the theory from an educational perspective, but we will also look at the price action in market averages, since it reveals some discomforting divergences that question the true health of the stock market's present condition, as we are seeing in the charts in front of us. For those of you unfamiliar with Dow theory, it was derived from a series of Wall Street Journal articles written by the newspaper's founding editor Charles Henry Dow in the late 19th century. In the late 19th century, Charles Dow set up two averages, specifically the industrials and the railroads averages, in an effort to study market trends. It was not initially thought as a forecasting system or as a way to trade the markets, but rather a way to measure economic trends or the state of the economy through financial markets. Since financial markets through certain types of attributes they would be always in front of the actual tendencies in the real economy. So the goal of the theory was at that time to and still is to determine changes in what is called the primary or major movement of the stock market. It's therefore built upon and concerned with nothing but the action of the stock market itself, and deriving nothing from the business statistics on which fundamentals depend. Something that is the core itself of technical analysis, which works based on prices and independent from other statistics or sources which are not reflected in price. The Dow theory is thus concerned with determining the direction of that primary trend of the market, and not so much the duration or the size of the trend. It is only concerned with the direction of trend, the direction of the economy, so to say, and has no forecasting value as to its ultimate duration or magnitude or size of that trend. Okay. although it says that primary trends usually last for more than a year and will have an appreciation of more than 20%, we'll see some of these minor aspects or characteristics of the different types of trends which have been defined originally by the Dow Theory. So I will take some of the basic tenets of the Dow Theory, and by the hand of these tenets will or principles, we'll try to see if these ideas, which have been formulated over 100 years ago, are still valid, or if we can extract something of value for us today, even if we are probably here in the room more concerned with very short-term trends or with markets that have very different characteristics than the ones that were seen by the time when Charles Dow wrote down the first ideas around what became later on the Dow Theory. And we will see also by rescuing some of these basic tenets that although being very basic, some of them are too obvious, we can we can still in many instances delve deeper into such concepts like the discounting mechanism or the confirmation principle and so on, and still extract information or knowledge from these valid ideas. Okay, so one of the basic tenets, which is normally mentioned when talked about Dow theory, is that the primary trend is unviolated. This means the primary trend cannot be manipulated. Primary trend would be something that here on the current chart we will see as something lasting for more than a year, and we have on this chart we see here 2 years of price action. If we go a bit and we zoom out in this chart, we see that we have this primary trend here since the crisis-induced lows here in 2009, and that would qualify as a primary or major trend according to the Dow theory. Okay, we have in between some corrections, which are called secondary reactions in the Dow theory, and that major trend will be called that primary trend, which is said to be unviolated. Through this first principle, we can deduce that shorter trends, that is secondary trends or primary trends or even intraday trends, which the theory was not concerned with, can be manipulated. That is something that we can deduce out of this first basic tenet. And by manipulation, it's not meant that there is someone who is taking prices up and down accordingly to preferences, personal preferences, or whatever, but that idea should give us some food for thought as how vulnerable prices in the very short term are to manipulations, not specifically manipulations of taking prices to a certain wished level, but the fact that a minor event in the market, it can be the confluence or the way that order flow is given at a certain moment. Prices can start a small 2-3 day trend out of something that was not fundamentally driven or is in accordance to fundamentals at that time, but due to some confluence of orders in the market. Okay, this goes against the many times false myth that is spread in especially in the forex market, where this deep liquidity is taken as an argument to attract investors to this market. And if we have a closer look into that, we see that it is not logical to speak of those liquidity levels which are reported, since they take everything in the equation. They take swaps, they take forward contracts, and so on. So if we would look into real liquidity that is available in the forex market, we'll come into a very smaller number, especially if we would look into liquidity on a minute by minute or second by second basis. Something that we do is usually seen in the forex market, which is accounting for the whole volume of the market, since there is no central place where the execution takes place. Imagine that we will sum or add together all the liquidity that is being traded across all exchanges in the world, or all the stock exchanges in the world. Sum that together, that will also give a huge number, and that is an argument that we never see when we talk about equity markets. So why it is done in the forex? So this primary basic tenet can serve as a food for thought, if not very practical in the first instance, but can lead us to very interesting discussions around liquidity and market manipulation, so to say. The second basic tenet of Dow's theory would be the fact that averages discount everything. That means information, interpretation of that information, and also expectations. That is, the value of the stock is the perceived value of the company, and it is reflected in the price of that stock. Okay, it says that fresh information is quickly reflected in price. So market participants typically anticipate a future economic and financial development and take action by buying or selling the appropriate assets with the result that a market normally reaches a major turning point well ahead of the actual development, something that we see even on a day-to-day basis. So these expectations about information is that anticipation of what may happen in the near future, and that is the so-called discounting mechanism, when those anticipations are already being accounted for, and market participants act as they would. These events that are expected will already be reality. And still nowadays, technical analysis assumes that the price discounts everything, that information, interpretation, and expectations derived from that information are discounted. The difference to the original thought and the premise, that premise that was also taken by the efficient market hypothesis, saying that the market essentially discounts or reflects in their prices all past, present, and potential future information, is that for technical analysis, exogenous events like can be news and anything that is not derived from price itself, that they are not instantly taken into consideration by market participants. Something that the most recent versions of the efficient market hypothesis, or softer versions of the efficient market hypothesis have considered, but something that was always stated by technical analysis, that information is not immediately digested by all market participants. And this is something that we constantly see. If you have been in the room in the previous webinar with Telmo Pinto, he always incorporates uh, sentiment indicators and this approach, this contrary approach to markets, and constantly searches for these divergences between uh, what market participants are discounting and those facts that are becoming a reality, but are taking time to be discounted by market participants, creating these gaps between expectations and reality, and thus these oscillations above and below what would be the true value of a financial asset. Okay. It is also said that the market never discounts the same thing twice. It's an old saying that goes, a beer argument known is a beer argument understood. I will mention a few of these old adages here in the room, if you want to take note for your trading diary. They may contain some wise words, and in this way, all markets, all asset classes, the bond market, the stock market, the commodity markets, and the currency markets, they move in different directions simultaneously because they discount different things. The bond market discounts, for instance, interest rates. The stock market discounts growth in the economy, the state of the economy. Commodity markets probably discount inflation. And currency markets, although an animal of its own, would discount probably money flows. So each market is discounting different things, and this gives this is the foundation what we have talked in some webinars of what is known as intermarket analysis, where we take different markets, read across these markets, and knowing the relationships that there are in the different asset classes, and knowing what these markets usually discount, then we can extract that vast panoramic global view of what is happening. Okay. So far, any questions as for the discounting mechanism? Okay. The 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 third basic principle of Dow theory is a more shorter one, which says simply that Dow theory is not infallible, that it requires serious and impartial study. That would be valid as well for technical analysis today. By serious study, we would mean a scientific approach in that we have a working hypothesis. There are observations. We formulate an hypothesis, and then we test. We try to prove that hypothesis. And by impartial study is mean that our study, that our approach should be unbiased, so to say. Okay. Here on the chart in front of us, we have in blue the industrial average. In gray, it's the transportation average, original the railroad, and in red the utility. Okay, we see the industrial average is delivering solid double-digit percentage point gains since the end of last year, where we registered these lows here. We haven't here on the chart, but the S&P 500 has also returned to levels that prevailed just before the stock prices collapsed in autumn 2008. So we are reaching highs here, as reflected in the averages. But it is often said that bull markets climb a wall of worry, and this is also an old 19th century adage, which has certainly proven true in the year to date, and we shall see where these technical arguments are, which would mean that that wall of worry. There are surely some technical arguments that we will see that point to a very mature trend and eventually change in the market conditions. So right now, long-term investors and traders are cheerful, happy to buy typical diehard bulls, but we will see that the latest upward move, that one that we can have it probably a little bit zoomed here in the chart. We'll see that this latest upward move has been accompanied by a deterioration of technical indicators accordingly to the Dow Theory. Yeah. Also by a growing air of complacency among the professional investment community. By complacency, we can have a look into the VIX, for instance, which also speaks of the quality of that trend. Let me just try to put the VIX here. On a second tab. Let me see if I can get that. Okay, oops. Okay, here we have it. You have more or less. Okay, you can correlate here to the previous chart. Okay, where we see the S&P here in blue and the low levels in the VIX, translating that complacency among investors. Okay. Yeah, Dan is asking the potential divergence between the industrials and transportation is warning further upside, but feel it will probably resolve to the upside with new quantitative easing driving the stocks higher. What is your take? Yeah, that would be certainly a point. That will be certainly a point. We will try to delve into that in very briefly. We will take at this point, maybe here what we have been seeing as these major primary trend to the upside, and the secondary reactions here as seen here in the charts. We see the reactions across all the averages, and this warning that Dan was mentioning, this is derived from another of the principles that we have adopted from Dow Theory, which is the principle of confirmation. In the Dow Theory, confirmation was initially the consideration only of the industrial and the railroad averages together. Railroads being here the gray one, the transportation. So the confirmation or a change in the major trend would come when both the industrial and railroad averages reach new lows, and in the case we have here, would reach new lows together on a day closing basis. If we would have here on the day closing basis lower lows than the previous secondary reaction in both averages, there will be a change in trend from bull to a bear market. Okay, vice versa. In a change from a bear market to a bull market, we'll have the same principle used. Okay. Accordingly to the Dow theory, the rationale of goods being produced and shipped should be used to explain the stock market action. It is not possible to have a healthy economy in which goods are manufactured, which is reflected through the industrials average, but not sold, that is not shipped, which would be reflected in the transportation. Okay. So once confirmed by both averages, the new trend is assumed to be in existence until that offsetting confirmation that reversal by both averages takes place. Today, we use three major averages. We use the industrial, transportation, and the utilities, and two of them should use to confirm that change in trend. Here is worth mentioning that the averages all stress the general trend of the market that rather than that of individual stocks. Okay, Dow believed that the stocks would react in synchronicity with other stocks. That is, the herd mentality in action would make the averages reflect the overall positioning of investors. We can extrapolate this idea of confirmation, and we may take other indices, for instance, global indices, and search for confirmations on a global scale. If we see here through the averages, if we can get an idea of what is going on in the North American market, we could use the same principle and try to compare different global indices, which would take the S&P and for the United States and compare it to major indices through Europe, Asia, and so on, and see if the movement is seen across all the indices or if there is some lack of confirmation. And here we have again the concept. If there is a kind of divergence, if any of these indices is not making is failing to print a new high, and therefore alarming that that major trend is not generalized. And since we know that there is always this herd mentality in action, if that is not reflected across all markets or all markets comprehending one same asset class, like equities in this case, then that would be reason to watch for an eventual change in direction. MRCs, we see a correlation between blue, red, and light blue. Right, the correlation in that case exists, but in this case, I think it's enough to have that visual, to have that little access to the averages to see that the correlation is positive, but for a finer analysis, we could eventually do some calculations on correlations or even relative strengths, dividing the value of one average through the other, and make a ratio out of it in order to fine tune the analysis. But this would be not a conventional approach to the Dow theory, and that is why I didn't choose to enter into these very fine-tuned techniques. In the case of the confirmation, that is the two of these three averages closing below these lows here, we may switch here probably to an interactive chart so that I can draw it here on the chart. That would be the low in question. Okay, we would or maybe I use a circle. That would be the low which we would be looking at in order to reverse the trend. So a close below that secondary reaction low here, that would signify a change in the primary trend. But that confirmation has to be said. It's not necessary that happens on the same day. We can have those daily closes below that point on different days, and that would be a valid confirmation. Okay, and until a pattern of change in trend, until a pattern has been formed and completed, the assumption should be that the prevailing trend is still operative. That is, that the pattern is one of consolidation or continuation. In that case, we still see that there is a continuation, and especially in when expecting new quantitative easing. So right now, there are still the evidence is still of a continuation more than a change in trend. But we start to have some technical alarming situations here that would eventually point to a change in trend, like the fact that the transportation average, the gray one here on the chart, is failing to surpass the highs reached in summer last year. As you can see here, there is this divergence here in this average, while we have the lower highs in the industrials. Okay, and also higher highs, pardon, in the industrials, also higher highs in the utilities. Okay. So as we said, the pattern would be right now of continuation, but this principle is more important when the trend has been in existence for only a relative short period. Because the more mature the trend is, the greater the probability of an important reversal. That would be surely the case where we have here a third phase of a primary bull market, since we already had two secondary reactions in this primary trend. Okay, the secondary reactions, as we have seen here in this longer term chart. We go back here to this one, okay, where we had this reaction here and that one. Okay. These are the secondary reactions, okay, that we had highlighted here in the industrials, and we had this. Pardon. We had these three market phases, so we can from that point of view, we would be facing here a mature trend, one with more probability for a reversal. So, and that is also an argument waiting in the direction of a change in trend. A change in trend might not signify a change in direction. It can be a change through a lateral condition, But accordingly to the idealized model in the Dow Theory, after an uptrend and a sideways consolidation, there would be a bear market. Okay, that is would be the idealized picture, so to say. So the refusal of the average to confirm the other, that is, we have a divergence, is never produces a signal of any sort. So like we have seen in previous webinars where we talked about divergences with oscillators and so on. I stressed a lot the fact that a divergence is not a signal in itself. It's a situation which can serve as an alarm, but it's not a signal in itself. And that is something that we have learned from the beginnings of technical analysis, and something that has been stated already in the Dow Theory. So divergences sometimes occur at reversals in the major trend, but they also occur at times when no major reversal is developing. The simple truth is that many more reversals have come when the averages were in agreement than when they were divergent. So this would also make us alert to a possible change in trend without a very clear divergence here. Some analysts say that breaking this pattern of rising lows or falling peaks is an important but not an equivocal warning of a reversal in the primary trend. That technicians should derive a similar conclusion from a consensus of indicators. This is something that modern technicians have added to the theory. They say that the odds increase that a technical signal is correct if there is confirmation from another unrelated indicator. This is something that should give us also some food for thought in system construction. We should always search for that confirmation among unrelated or uncorrelated indicators. The more unrelated and uncorrelated our indicators are, or the nature of the rules that we are using in our system, the more probabilities we have that confirmation is not giving redundant information. For instance, momentum indicators, oscillators, they are based on price data. Means they do not add genuine new information to the analysis. They are simply manipulations of the same data. And the analyst must therefore be careful when using price indicators, as I said, confirmation may be more redundant than informative. Okay. And regarding confirmation, it is interesting to know that this recent cyclical high in the industrials has not been confirmed yet by the transports. And so we can see from the chart the transportation average reached a cyclical peak during the summer 2011, and registered a lower high as we see here this year. To mention another adage from Ria, a successor of Hamilton and Dow, he warned that a wise man lets the market alone when the averages disagree. I will copy that. That will be another of the adages that we may take for our intraday trading. We see on the bottom of the chart there is volume. Another of the basic principles say that volume goes with the trend. Okay, it confirms the price move. So in a bull market, volume increases when prices rise and dwindles as prices decline, and in bear markets, turnover increases when prices drop and dries up as they recover. And it's only the overall and relative volume trend over a period of time that may produce helpful indications, and not the volume of every of this single session. And as we can see here, we have a here in this crash here in the middle of 2011, we have associated increases in volume, and since then, and accompanying the rise, we have since then a declining volume, which is not very supportive of that bull trend. Okay, and although volume has been considered in the Dow Theory, it is not a primary consideration. Okay, the price is overrides any consideration of volume. Also, for volume only, close prices are used, and the changes in the closing prices reflect that aggregate judgment and emotions of all stock market players, both current and potential. In you may ask if the averages can be still used today, and that is will be a valid question, since the economy is so different today than it was back then when the averages were conceived, where the general relationship between economic activity and sectors of the economy is measured differently. The usual method today of confirming probably a primary trend is maybe to use the confirmation between two indices, the S&P and the Russell. We may switch very briefly to this chart. Let me see here. S&P and Russell, we would have a similar reading here. Okay, where we are having higher highs on the S&P, and right now touching the highs in the Russell. Okay, the S&P would represent the largest highly capitalized companies, and the Russell 2000 the smaller and with a more technological base. MRC, are these tradable indices or some average? Nowadays, through the futures markets, indices and averages are tradable, which is something that was not original. So when the averages were conceived, they were not thought as a trading vehicle, but an indicator to measure the health of the economy. Yeah. But the information for us would be, since we are more concerned with the forex markets, would be more for an intermarket approach. Means if we are seeing a confirmation to the upside in that case, and a continuation of a bull trend, that would isolatedly at least would speak for an appetite for risky assets. And we would obviously search among our currency pairs. We would watch those that are traded also to the upside when there is an appetite for risk, or vice versa. So we would try to extrapolate some of the discounting factors from one market to the other. Okay, and if we start to see many technical failures or lack of confirmation, then we would probably import that analysis to our currency pair and see, okay, I'm trading euro dollar, for instance, but I would be careful of these recent up moves into new highs, since the stock markets are already staging some alarming signs for a reversal and risk aversion, so to say. So we could use the averages in an intermarket approach, but the idea is also that we extrapolate some of these ideas like confirmation also to our analysis. Okay. When I say confirmation, I also say all the basic tenets that we have been mentioning, like the discounting mechanism and so on and so on. Okay. Volume is something that we do not have directly in the spot market, but we may supplant that by looking at volume in other markets or other currency instruments like future, for instance. Okay, so at this juncture, we can say that there is a potential downside. There is a potential downside if we go here back to. We may look here at what happens, for instance, with the utilities, and we may search for a more clear signal here of what the utilities is doing, since the action on or the interplay among those the other two averages has been explained, and we can, for instance, go and see the. Let me check here. We can go and have a look to the utilities average from a different angle. Here we have the utility basically on a line chart, but we could, for instance, in order to have a more objective view on what this average is doing, switch to another chart construction. This is something that we briefly talked also in previous webinars about pointing figure. It's not a very usual approach, but a very objective one. Here on this chart, probably on a very large horizon, since we have here price action since 2009. So we would be looking at this action here around the top and search for any reversal signal in this area. Probably we would here choose another box size in order to have a more sensible chart, and maybe we can change the box size here, and here we have that action around the top that we had in the utilities. Okay, here we have it in a fulcrum reversal pattern, and we see this clear support here, which is right now being rejected, but on a close below, that will be a signal accordingly to the pricing to the point in pivot part of point in figure charts, and carry with it a series of objective targets that could be calculated through these patterns. Okay, and that would point us to a number well below, and if those targets are confluent in a certain area, that would give us a very early signal of a change in the Dow Jones utility average. Also, knowing that utilities are interest rate sensitive, we prefer to look at a combination of utilities with bonds. Let me see if we have here. We have here the utilities. The utilities in red. We were looking at a price figure chart. We are looking at this high here and the price action right at the place where we are here. Okay, and for a reversal here, and here we have thus the treasury note yield, and compared with utilities. In green we have the yields, and since utilities react negatively to a rise in yields, we would be analyzing the yield chart, the 10-year yield chart, for a breakout to the upside as a signal here, to be confluent with a breakout to the downside and utility. So all sorts of intermarket relationships that could be used to add to our technical argument. I don't know if so far if there are more questions. In what we have been talking here about the different types of trends in the Dow Theory, there is the primary trend, which is something that we have been more focusing on, the primary trend, that is measured in months and years, that is unviolate, and they are also operative in other asset classes like bonds, equities, commodities. They also apply for currencies. But in currency, since these reflect investors' attitudes towards the interrelationship of two different economies, an analysis of currency relationships does not fit very neatly into this cycle approach. But in order to answer also Boyke's question, all this relates to forex. That would be what I just mentioned before. That you can take the readings of the averages as an analytical approach to the state of the North American equity markets, and extrapolate that from a risk appetite point of view to currency pairs. Okay, this is one approach of one use of intermarket relationship that can be done. Then there is the secondary or intermediary trend, which are these, in this case, these movements here to counter to the main trend. They are measured in weeks or months, so that the duration of the trend already helps to classify them. They are called secondary reaction in Dow Theory. And that is an intermediate trend that runs counter to the primary trend. It's counter-cyclical, so to say. Any price movement that retraces at least 1/3 of the preceding net move in the primary direction, from the end of the preceding secondary to the beginning of this one, means 1/3 from this distance, can be classified as such. Okay. So the changes in those intermediate trends aid in the identification of turning points in the primary trend. One of the criticisms that Dow Theory has been receiving is the fact that it's late in recognizing if a secondary reaction is a new trend, or if there is a continuation. So there is a certain lag in identification of the new trend, and basically when using Dow Theory in order to capitalize in the markets, practically the investor would only be able to capitalize in the middle third of a bull or bear market. So you will lose that first part of the move, which initially can be a secondary reaction, and until there is a confirmation and the start of a new bear or bull market, then comes the moment when the investor can start piling positions, but you would be out or in the next secondary reaction, means losing the third of that primary move. So essentially, what you take is the meat of you distinguish between the meat from the bone, from the entire movement. Something that the more conservative traders among us can surely take note of, and go for that central part or of an entire price move, and not trying to pick absolute highs and lows. Okay. There is more that can be said about these primary trends, but unfortunately we are reaching the later part of or the final stages of the session. MRC are saying that treasury note. This is the treasury note yield that I had in the chart. It's not the note, the bond price, but the yield, which goes inverse to the utilities. If you plot the bond price, then you have a positive correlation. But since bonds and yields go opposite, that is why there was a negative correlation between the two. Okay, thank you very much for your attention in this session, which was surely not easy in all aspects, and probably not as exciting as other sessions where currency charts are seen. But I hope some of the ideas that were discussed can be of use to your trading. Thanks for staying in the room and asking questions, and for the participation as always. And hopefully see you soon with another topic. Bye bye. Thank you. Have a nice day.